Too many homeowners think about their mortgage all wrong, completely wrong. They either race to pay it off early or they just keep refinancing it every 4 or 5 years. Stop putzing with your mortgage.
Putzing? Did you just say
I
putzing?
did say putzing.
My mother used that word all the time. Sorry.
Welcome to the Bucks Outside the Box show, where we challenge conventional money advice and get a little contrarian sometimes. So, on that note, let's think outside the box here and dive in about why your home is your worst performing asset and why you need to stop messing around with it.
And just
So,
real quick, don't you think most people actually have the opposite point of view?
that it's their best asset?
Yes.
Well, it's certainly the asset that they're most emotionally tied to, right? So, and it's front of mind because you see it every day. Whereas you probably shouldn't be looking at your stock portfolio every day or your passive real estate investments every day, right? That's the whole point, is to let them generate returns for you in the background and not fixate on them. Whereas, we all kind of fixate on our homes because we live in them and we see them every day. So it's front of mind. But your home, for one thing, is your most illiquid asset. It also performs the worst of all your assets in almost all cases. So let's dive into that a little bit deeper here. So liquidity, that's an easy one. It's really expensive to pull money out of your home, and it takes a long time. So you could sell your house, then you don't have a place to live, and you have to buy a new house or rent a home, or whatever you choose to do. You can go live in a van by the river, I suppose. But yeah, your equity in your home is very illiquid. So you don't want to race to add more of that, right? To like funnel your liquid cash that could be invested into assets that actually return, high annualized returns, stocks, passive real estate, whatever that might be. People are just like throwing that into their home equity, where it's all
Pay it
locked up,
down.
and it's really hard to get to and
Well,
expensive to get.
my generation, Brian, we were taught pay down that mortgage, pay down that mortgage. That was how we grew up.
And there are times when that is good advice. I mean, there were times in the 80s when mortgage rates were like 15%, right? In which case you do want to pay it off. I mean, but in a world where people have mortgages that are in the like 2 to 6% range, you don't necessarily just want to run out and pay off that home as fast as possible and add to that equity that's locked up and you can't access easily. Uh, and so let's talk about returns for a second here. That segues
Mhm.
well to that. So historically, U.S. homes have appreciated roughly in the 2 to 4% a year range. There have been times when that's been higher, like immediately after the pandemic, or in mid-pandemic to the end of the pandemic. And there were some cities where homes appreciated by 10% a year. Uh,
Mm.
but that's very unusual. And there have been plenty of times when there's been negative appreciation, like in the Great Recession in the 2008 housing crisis. Homes across the country dropped in value by 25 to 30%. I mean, that's a huge crash in value. Over the last 18 months, in most, or as a nationwide average anyway, homes have been flat. Um, Zillow, the last time I checked Zillow, which was probably 2 weeks ago on this, so not immediately, but pretty recently, it was homes as a nationwide average, homes had appreciated by 0.1% over the last 12 months.
That hurts.
So, the point just being, sometimes homes appreciate faster than that typical 2 to 4% range. Sometimes they are totally flat, like they have been over the last 18 months or so. Sometimes they drop in value, but, you know, long term average 2 to 4% appreciation, that's not a great return, right? I mean, you can go find a high yield savings account that pays that, basically, right? Like, and these are not impressive returns. There's nothing wrong with it. And of course, our homes serve another role in our lives. I mean, they provide shelter, which we all need, right? But we want to think about our home as a living expense, right? The less you pay towards it, the better. Like any other living expense. If you were renting, same thing. If you're buying groceries, or the less you spend on it, the better, because that leaves you more money to go like put towards savings and investments and retirement assets and so forth. Um,
What are your thoughts about taking money out to improve that property?
Well, there's two points on that. And actually, I think we did an episode on this not too long ago about how almost all home improvements have negative returns, at least in the sense that they cost more to make than what your property goes up in value when you go to sell it, right? So there are almost no home improvements that add more value to your home than what they cost you to make.
Right.
There are some other factors at play there, like your greater appreciation for your home, while you're living there, your greater enjoyment of your home while you're living there, right? So you can try to put a dollar value on that to help you make that calculus. Um, or it might making those home improvements might enable you to stay in your home instead of moving to a new home and buying a new home, which is very expensive to buy a new home and move. Incurs several rounds of closing costs, both selling your current home and buying the new one. So, if you can make a modification to your current home and that will help you avoid buying a new one and selling your current home, then that's part of the calculus as well. So, but that's a different conversation.
Right.
So the idea here is that most of us today have relatively low mortgage interest rates, on our existing mortgages. Again, often in that 2 to 6% range, and that opens the door for arbitrage, where we can take money that we would have spent paying down our mortgage and we can invest it and earn a much higher, or we can earn a difference, right? We can earn a spread between what we're investing at and earning from those investments versus what
Mm.
we would be saving by paying off our mortgage. So for example, the S&P 500 has historically returned 8 to 10% a year. Now, again, that's an average. Sometimes it's more, sometimes it's less. Um, the assets that you and I invest in the co-investing club that we meet every month to vet together, we're aiming for 15% plus annualized returns in those.
Right.
And in some cases, that's income yield. I mean, and to pick one example that just came to mind, we've invested in that land fund that has paid 16% a year in
Mm.
distributions like clockwork since inception, right?
Yes.
So, if you have the choice of paying down your 3% mortgage versus earning 16% on your money in that fund, just paying distributions every quarter, that's a no brainer. And I get that, some people, especially as they approach retirement, they get scared. There's all this emotion around like, oh, I really should have my home paid off. Well, maybe, but not necessarily from a financial calculation perspective. Maybe
Right.
that's from an emotional, like, I'm not sleeping at night because I'm so scared kind of thing. Again, it's like these externalities, right? These things that aren't, based on like the math fundamentals, but they're nonetheless like part of the decision, right? Um, anyway, so these are all arguments why you should stop paying down your mortgage early. At the other extreme of the spectrum, you've got people who are just maximizing their debt against their house, and they're going out and refinancing their home every 4 or 5 years, as soon as they can. Well, that runs into all kinds of problems too, where first of all, it's really expensive to refinance your home. You're looking at 5 grand, 10 grand, whatever it is in closing costs. It's a lot, and it always ends up
Yeah.
being more than what your loan officer initially tells you it's
Oh
going to be.
my goodness, that's so true.
Right? It's thousands and thousands of dollars that you don't need to spend. Is the bottom line. I mean, and yes, there's always someone who'll be like, well, I do have to do it because I need this money for something else or whatever. But bottom line, it's almost always an optional thing to do, right? Refinancing your mortgage. So, don't rush out to do that. The first year that you take out a mortgage at 6% interest, for example, you're going to be paying 5 times as much interest in that first year as
Right.
you're paying towards paying down your principal balance. So, this is the other point here is, and that a lot of people don't understand, is the concept of an amortization schedule for their loan. So when you refinance your mortgage, you start back at square one with the amortization schedule where most of your monthly payment is going towards interest again. And then over the course of a loan, of an installment loan like a mortgage, over the course of that term, more and more of each monthly payment goes towards paying down principal until by the end of, by the last year in a 30-year mortgage loan, almost all of each payment is going towards principal, reducing your principal balance.
It
Whereas it's the
is funny
opposite at the beginning.
too that you mention how few people understand that because as a realtor, I just assumed people wouldn't understand how that works, but they actually do not.
No, it's surprising to me how many smart, well-educated people don't understand how amortization works. Now, granted, they don't teach that stuff in school unless you're like a finance major or something, right? Uh, they certainly don't teach it in high school. But this is an important part of this, right? So stop messing with your mortgage, right? Like, stop going out and refinancing it. You're shooting yourself in the foot financially. And then the other problem here is you are extending your debt horizon basically indefinitely into the future, right? Forever debt. So, we did talk about how as you get older, as you get towards retirement, people start thinking about, oh, should I pay down my mortgage to reduce risk? As you get older, you do want to reduce risk in your
Right.
portfolio. I would argue that paying off your mortgage is maybe not
Top
it's not the
priority.
top priority for reducing risk. There's other ways to reduce risk first. For some people, it does make sense. But what doesn't normally make sense is extending your debt horizon just indefinitely into the future, right? And keeping that debt forever. Um, yeah, I mean, these are all reasons not to go out and just keep refinancing over and over and over and keep paying those closing costs, keep paying the higher interest, relative for each payment. Yeah, you do need a home. We all need shelter. Your home is not an investment. It is a living expense. The less you
Yes.
spend on it, the better. Your investments are things like your stock portfolio or real estate syndications or private, going in as a private partner or silent partner on a real estate deal, like what we do. We're actually meeting later today as we record this uh,
Right.
to vet a private partnership together as an investment club. Private notes, bonds, like these are true investments as
And then
opposed to
there
your home.
is, active real estate investing, but I can tell you right now, woo, that burns you out a little bit.
Well, that's a side hustle. And it's also a form of investing, but it requires a business. It's a side business or a
Right.
full time business for a lot of investors. That's, so starting a business can be an investment, but it's also a business, right? And it
Right.
requires a lot of labor. Uh, all right. On that note, Jenny, do you have anything you want to add before we call this episode complete?
No, I think that one of the things I like about investing with our club is the low amounts you need. So it allows you to be very diverse and reduces the risk. And it's affordable, so you don't have to take out of your mortgage.
There you go. Yeah, no, yeah. We didn't talk much about our co-investing club in this episode, which is totally fine. But yeah, it really helps to go in on these kind of big, expensive investments with a whole bunch of other investors and have their eyeballs on these deals too. All vetting risk together, and all investing with small amounts. So, yeah, if you are curious about any of that, about how passive real estate investments work, since they are unfamiliar for most people, we have a free course on it, sparkrental.com/free. It's 8 episodes. They're all quick and snappy. There's no fluff. And if you got a fresh perspective from this episode, please subscribe to the show for more awesomeness every week and pass it along to a friend, family member, colleague, second cousin twice removed. And if you didn't get anything out of this episode, shoot us an email and let us know what you are looking for. Support at sparkrental.com. And note, stay weird, unconventional investor.